Hello, Ashwin.
How are you?
We are now in the second week of the second half of the year, 2022. And I must say that reading various reports, the market outlook has not been very encouraging. May I just read you some of my research, and then I'd like your take on it, please.
Yes, of
so
course.
Deutsche says the second half is not looking good. Of course, we've been seeing the numbers. The S&P 500 closed out its largest first half decline since 1970 last week, down 20.6% since the turn of the year. The Pan-European stocks 600 ended the half down 16.6%, and the MSCI World dropped 18%. I'm sure other bourses have also dropped more than 20%. What say you, Ashwin?
Well, like you just mentioned, Deutsche says the second half is not looking good. It's true. Okay, the S&P is down. The macroeconomic outlook, Deutsche says, remains uniquely uncertain as the war in Ukraine and inflationary pressures persist, promoting central banks to embark on aggressive monetary policy tightening and exacerbating fears of a global economic slowdown. This is what has caused the whole market meltdown since March 27. Okay, HSBC Asset Management advised investors that the economic regime, listen very carefully, appears to be shifting, and adverse supply shocks persist. Globalization is slowing, and commodity prices remain spectacularly high. And all of this while governments attempt to manage the transition risk of changes in climate policy. So a lot of things are happening here. Interest rates going up, commodity price going up, war in Ukraine, a lot of pressures from all angles. So HSBC's chief global strategist, Joe Little, called the end of an era of what economists dubbed secular stagnation. Okay, characterized by historically low inflation and interest rates. That era is gone. That cycle is gone. It lasted for 2 years. Those of you who did not buy stock 2 years ago, you missed a big chance. I'm not saying that you still cannot buy stocks. It's not a broad-based market anymore. It's going to be a niche market. Depends what you buy. Now, although HSBC expects inflation to gradually cool off from its current multi-decade highs in many economies, okay, but HSBC says the new norm, listen to this, please. The new norm, like I said, it's not going to be broad-based market anymore. The new norm is likely to be steeper price increases in the medium term, leading to a phase of higher interest rates. Now, the major thing for investors to understand is this. The stock market will still go up, but only companies that do not depend on borrowed money and loans, they will do very well. Companies who heavily depend on borrowed money and loans will not do well.
In my country, Malaysia, our Bank Negara just raised interest rates again. Of course, it was expected that the ringgit would do better after that, but it didn't.
I'll tell you why, Tessie, I'll tell you why. You see, the whole world is increasing interest rates by 50 to 100 points. I mentioned this in previous videos before. But in Malaysia, if you're going to raise your interest rates by 25 to 50 points, and I can tell you now, it's the maximum they will do, 50 points. That's it. That's it. So vis-a-vis the entire world, Malaysia's interest rate of 50-point increase, actually, we do not consider it as an impact. So that's why the ringgit still dropped after the interest rate hike.
It was just a drop in the ocean, yeah.
You see, let me explain to you. By July, the US would have increased interest rates by 225 basis points, meaning 2.25%. What you are seeing in Malaysia is only 50 basis points, that is 0.5%. That explains it all the way, right?
So inflation is causing prices to rise, you know, and our stock market is not doing well. I wonder when the end is in sight. So we've talked about it, and we've read out that October 19th seems to be a magic day mentioned.
I don't want investors to be very sticky on October 19, because we will have to see what happens to the markets after this latest interest rate hike of 75 points by the Fed. What Goldman says, stocks face more downside risk even after a massive sell-off. Why? Because Goldman says profit margins across markets are still elevated, and some normalization would result in negative earnings revisions. So far, this week is earnings week. It's a very important week because now after increase of 1.5% in interest rates, we are going to see how companies react. And companies have to factor in further interest rate hikes of another 75 basis points. So we are expecting earnings to take a hit. Having said that, again, at the end of the day, even if earnings take a hit, the big companies who have no debt, no or low debt, will always. We've been saying this from day one.
Yeah.
Okay. So despite the S&P 500 already plunging 21% in the first 6 months of the year, making it the worst half since 1970, Goldman says that the S&P could hit 3,006 in a recession scenario. Right now, it's above 3,008 as I speak. So we are talking about a 200-point stock market drop from here. Well, which you ask me, Tessie, is actually good news for investors. I'll elaborate later how you can actually profit from this drop. So S&P has got a potential to drop another 220 points more from here. Now, according to minutes released last week on 6th July, Federal Reserve officials have already said that they would increase 50 to 75 points in the July meeting. What is more discouraging is this. GDP in the first quarter fell 1.6%. And according to the Atlanta Fed tracker, in the second quarter, we could see a decline of 2.1% in GDP.
So I must read this as opportunity, because when there's blood on the street, we go in and buy. That's been your mantra, hasn't it?
Yes, yes. But policymakers have said that they will take a restrictive stance against inflation and come very strict, okay, if inflation remains above 8.6%. That is the serious thing here. So that's what I'm saying. Do not put your hopes on October 19. Instead, focus on earnings and focus on the inflation number. Going forward, the next inflation number will tell us if it's going to be above 8.6%, we're in trouble. That means the market will drop some more. So we're already pointing now that if the inflation stays at 8.6 or higher, the S&P can drop 200 points. Now, I know what you're going to ask me, Jessie. Last Friday, the employment number was very strong.
Yeah, the June employment data was quite strong. I think I read it was 370,000 jobs created versus the 200 and something, expected jobs.
See, 372,000 jobs are created in June. That looks very good on the surface, right? Versus 165,000 jobs expected. But if you look closely, it is not that good. Let me explain why. There was a shrinkage. There was a loss of 74,000 jobs over the last 2 months in the US after revising the old data. The labor force shrank by 350,000 people, which means the number of people looking for a job actually became smaller. Okay, a scarcer supply of labor. This is what we're worried about. A scarcer supply of labor, because labor force is tight, right? Will be a problem for the Fed to achieve a 2% inflation rate, because when there's not enough good labor force to go around, people will offer them more salaries, and that will cause inflation.
Right.
Because a select number of people will be earning very high salaries.
Yeah.
Money to spend.
Yeah. And
one more thing. The average work week hours in the US in the month of June decreased to 34.5 hours. Means they're getting paid more and they're working lesser hours.
I heard that, I read somewhere rather that Fed's Powell stated this has been his worst run ever.
Yes, yes.
Since he took office.
Now, you know the bond market, right, Jessie? A lot of high net worth individuals we've been talking to have been losing money in bonds. I think
I know. Actually, I have so many friends who believe buying bonds is like a safe haven compared to the volatility in the stock markets. They are told by their bankers, by their agents, if you buy bonds, you won't get as much returns, but it'll be a safe haven. It's capital protected, And so many of my friends are stuck or have lost money.
Let me explain to you why, Tessie. 2 years ago, it was correct. You buy
I don't
bonds.
understand how bonds can lose money.
I tell you why. 2 years ago, it was okay. You can buy 60% of your portfolio in stocks, 40% in bonds. When the stock market drops, the bond market goes up, you know you are okay. It's already matched. That's why they call it 60-40 ratio. But as of 2022, and I've said this in my video even in last year, in November last year, we warned in our video, we said, investors, please do not buy bonds. Why? Because with this interest rate hikes, such steep interest rate hikes the Fed has conducted, the 60-40 ratio does not work. So the protection has vanished. Investors are shocked because stocks drop, bonds drop, both drop. Where's your protection?
This has been exacerbated by the Ukraine war, by the post-pandemic logistical.
We will talk about it in the later video. And also because the Fed, in our opinion, has done a very big mistake, a boo-boo. They could have, for this 60-40 ratio to work, they could have increased interest rates slowly by 25 points at a time last year. But they did not. They kept quiet and said inflation is transitory. It's no danger. They were wrong. Janet Yellen confessed and said, we were wrong. So because of the Fed's mistake, the investor suffers and the bond market drops, offering the investor no protection. I wonder if any of our high-level individuals have the banks actually explained to them, because frankly, I'm not running anyone down. If I was an investor last year and my bank comes to me and says, buy bonds, I will turn around and tell the bank, I see interest rates going up. Everybody says interest rates going up in 2022. Why are you asking me to buy bonds? Now, I'm telling every investor watching.
Ashwin, you know, I was an
investor.
investor.
To become street smart.
I was an investor like that who did not know how to ask the right questions.
Exactly. So you see this new dynamic, the investor has to have some kind of education.
I know, I'm trying to say that.
That's why we're sitting here now talking to you.
The reason why I'm pushing these talks with you is so that regular people like you and me, like me, can learn something and take our power back and know the reason behind the decisions that we are making.
See, I am not running the banks down, but the time has come.
I'm sorry, I was one of those investors.
Cannot blindly follow the banks.
I know, I was one of those who took advice all the time.
Now, let me tell you what FT has released this morning, a very serious report. Investors have pulled out $50 billion from emerging market bond funds this year, in the latest sign of how a sharp tightening of monetary policy in developed economies and the war in Ukraine has sparked a flight from the asset class.
So that's why most banks,
investors who are buying bonds should show this report to a banker and said, you said inflation, I mean, you said protection or whatever you said. This is fact.
This is an example of banks selling their products.
Yes, to make their money for themselves. I always said this. I'm not running any bank down, but this is a fact. Now, if last year we knew interest rates were going to go up, we warned them do not buy bonds. And if investors bought bonds last year, even before November, they were not thinking, I'm sorry. And listen to this. The net outflows from emerging market fixed income funds are the most severe in over the last, at least in 17 years. We have never seen kind of outflow in 17 years.
Ashwin, we need a solution. We need a compass.
I will come back to a solution in this video. Please stick around and don't switch it off. I will give you a solution, an exact solution that we have worked on since March, and now it's coming in our favor. This morning, 11th of July, China has warned that the factories are feeling some heat as US and Europe demand slows. Chinese manufacturers are starting to see demand for consumer goods in developed economies fall off after a strong rebound from pandemic shocks.
So this is post-Trump tariffs.
Yes, now, today, this is today's report. Spot ocean freight rates between China and major US and European markets are falling as consumer demand retreats. See, look at the difference. During the pandemic, freight was going up because not enough ships or whatever it is. Now it's reversing. So consumer demand is cooling off. Okay, in a way, it's a good sign because that means inflation should fall as well. But the problem is, if consumer demand falls too much, we could see a start of a small recession. I'm not saying a major recession, a small recession for a short time, maybe 3 months. Okay, Citibank says this: as costs of staples such as food and utilities rise, there is not much left for US consumers to spend on, particularly discretionary items. What the consumer is doing is this, and we have seen this in the last 2 months. They have stopped buying unnecessary things. They're only spending money on gasoline for their cars and food.
Yeah.
Everything else is going down.
What are we to do when the markets are so bad, Ashwin?
You see, Citibank says our sense is that consumers, particularly lower income consumers, are starting to crack. Now, this is where the problem lies. All this recession, inflation, it doesn't affect the rich. It affects the poor.
Yeah.
And you will see, mark my words, you will see the destruction, further destruction of the middle class. And it's very sad because these middle class people, they don't know how to protect their money. They don't know how to invest their money properly. So they don't have that kind of expertise that the rich.
They don't have the luxury of time that the rich people have. That financial independence, the financial freedom.
There are bills to pay. There are bills to pay.
Yes.
They don't have the time. They don't have the luxury. They don't have the
especially post-pandemic, Ashwin.
Yes.
So that is why I'm talking to you, because our calls have to be spot on.
Yes,
you know?
you have been spot on.
You have to calculate your risk reward and set portfolios very carefully so that there is no fluff, you know.
That is why we tell investors, if you want to do well, at least 100,000 minimum, not 50,000. Because in volatile markets, your 50,000 will not cut it. And that is the truth.
So you were saying you have a strategy now to make money amidst all this volatility and bad news.
Yes. I've said this before. Since March, we created a strategy, and the strategy has become even more better. So, like I said, the protection has vanished. Stocks are dropping, bonds are dropping. And those who invested in cryptocurrencies, Bitcoin is also dropping.
Everything is dropping.
So we have introduced a strategy where we can make money for you when stocks drop, when bonds drop, and when Bitcoin drops. Okay. That means you can either do it as a hedge if you are investor already holding Bitcoin or stocks or bonds, or you can do a fresh position to make money from a dropping market.
So some people might say, okay, money in the pocket is better than money out there at risk in the markets. So hold on.
No, if you hold on right now, if you hold on right now and you're holding physical bonds, physical stocks and Bitcoin, and if it goes down from here, your paper loss will widen. So how is that money in the pocket, money out there is better? If you are holding, let me repeat, if you're holding stocks, bonds, and Bitcoin, and if it drops further from here, you will be in trouble. You get a call margin. Okay, so our advice.
Rock in a hard place, Ash. Rock in a hard place. What do we do?
Our advice to people already holding stocks, bonds, and Bitcoin is to do our hedge so that your paper loss is preserved and will not widen any further if the market drops from here.
With a potential upside when the market recovers sometime post-October, hopefully.
What we do is this, for people already holding stocks, bonds, and Bitcoin, we do a strategy where your paper loss will be preserved. And if you can put in more money, you can make more money for yourself when the market drops further, and that profit can be used to offset your paper loss. And for new clients, you can make money as the market drops from here, if the market drops from here, which we are watching very closely, And let me repeat, in this strategy, we do not buy physical bonds, physical stocks, or the VIX index, or even physical Bitcoin or Bitcoin-related companies. These are strictly index and derivative strategies to protect you from further losses and to create profits for you if the market drops from here. It's a very highly strategy. And believe me, Tessie, you cannot do it yourself. Believe me.
So who are you talking to specifically, Ashwin? You're talking to the investors, the retail investors, who have a portfolio already, or
Yes.
who want to make money
From a dropping market.
from this dropping market,
Yes.
who have, say what, $100,000 US at least.
75 to 100,000.
Okay, and
Why I say
your
75 to
fee
100,
is
if it's only stocks, then 75,000. If you put in the Bitcoin, the crypto element, then 100,000.
so your fee is $5,000 US per year.
That's correct. The subscription is $5,000 US per year, and the money of 75 to 100,000, it'll be in your name, in your account, in your online broker, and we will tell you, we will do it for you. We will do it for you. We will do the strategy for you. Our subscription is $5,000 US, and we will deduct a 20% performance fee when we make profits for you.
And we're doing this sans the banks, yeah? We're doing this without the banks. We're doing this with an online, through an online broker, and with your advice.
Online broker is where the trades will happen, and we will do the trades for you after we obtain written permission from you to say you can trade on my behalf. And the money, I stress, the money will be in your account, in your name. We cannot touch the money.
So you will give these clients daily updates of their positions and discuss with them.
Into our research channel. We have a special research channel for clients on WhatsApp, and 24/7, they'll be guided by us as to what's happening.
All right. And your advice is directed by this algorithm.
Yeah, like I said, if you don't do this and the market drops further from here, you can of course afford a more paper loss. Why don't you instead make money if the market drops from here? You can either preserve your paper loss if the market drops further from here, or even make fresh money. You can make fresh profits from a market drop.
I'm just curious, what would somebody like Buffett be doing in a time like this?
Let me tell you, Buffett is big enough. So he can wait 2-3 years. He can afford a paper loss of 1, 2, 3, 5, 10 billion. It doesn't matter because Buffett is different. I can tell you, it's different from a retail investor. If you have the appetite,
he has the luxury of time and money.
If you have 100,000 or 500,000 paper loss, then you should start putting in more money and making money from the market drop.
Yeah,
we have clients who are worth about 5 to 10 million, and we set aside capital since March. We actually bought this strategy, and they've been making money as the market has been dropping. So it's how you want to call it. But what we're trying to assure you is that there is an opportunity in everything that happens. It's how you view it, is whether you can afford how much risk. That is
all I can hear is you're not going to be helpless and hopeless anymore.
Exactly.
With this strategy.
At least with this strategy, you don't have to be sitting down there at the mercy of the market and say, God, make the market go up. Please make the market go up. No,
it's horrible.
You don't have to be, you take the power back and say, I'm going to control now. So my bank asked me to buy bonds. I'm losing money on bonds. I'm going to do a strategy where when bonds drop further, I'll make money from that.
Yeah.
Like I said, please, clients, you have to be more smart nowadays. The bank says buy bonds for safety. You should turn around and say, interest rates are going to go up. Why do you ask me to buy bonds? But this is why people lose their shirt. They don't ask questions. In today's volatile markets, critical questions have to be asked.
Yes, one needs to know how to ask and what to ask. I've learned so much from you. I used to be that kind of investor. So I'm so grateful that, I have got your guidance. So how do we contact you?
We are here to guide investors who are lost. We are here to guide investors who don't know what to do and are praying every day to say, market, please go up, market, please go up. We are here for that. We are here for that. You can still continue dealing on with your banks. We're not running any banks now, but we are talking facts. Why are you buying bonds? Last November, we said, do not buy bonds.
Yeah, I remember.
Because we saw this happening. And the Fed is to blame, like I said, because they increase interest rates too much, too fast.
Yeah.
They've done 75 times 2, 1.5%. Now they're going to do 75 times 3, means total 2.25%. They could have done 25 points every 2 months last year and take their time to increase interest rates gradually so that the bond market did not get shocked and just collapse.
We have a saying, in Malaysia, when two elephants fight, all the middlemen get trampled upon. No, but the small man.
This time, Janet Yellen actually said we made a mistake. They kept on saying inflation is transitory.
So let's look at this.
Inflation will normalize after the pandemic was over. Wrong.
So let's look at this as an opportunity and go forward from there. How do we contact you, Ashwin?
You can email me at ashwin@ppchk.net. On WhatsApp, it's Ashwin. Sorry, it's bit.ly/algotrader. On WhatsApp, it's bit.ly/algotrader. And you can watch our videos on YouTube, bit.ly/algowealth. And if you drop us your email at bit.ly/algotrader, we can send you our daily research newsletter that we send out.
Thank you, Ashwin. See you soon.
Thank you very much.